we're going to talk about debt management and investing in our future. So I know a lot of people right now are kind of worried and questioning about what to do about student loan payments, the deferments that are coming out from the U.S. government. So through mid-September, there is no, on any federal student loan, there is no interest and no payment required. And you can also go in and ask for reimbursement if you already did pay in March. That is an option for you to save some money. So the interest will not grow through at least September, and it could be extended further, as well as the payment, and then you can get refunded if you already did pay in the month of March. And then as far as private loans, what I'm hearing as well is that you can go in and ask the banks or the lender for the same provisions. So you just have to talk to the private loan lender on that as an option as well. So let's dive into it as far as debt management versus investing in our future, and what that kind of looks like as far as what you're seeing out in the markets, Travis.
Yeah, well, thanks for having me here today. I'm glad to join you. Yeah, so for those of you that are in the position where things are a little tight with the coronavirus, it could make a lot of sense to look at your loans and see, especially the interest-free ones, which ones you can defer. If it's low interest and we're still having a tough situation with maybe work with the coronavirus, I don't think it's going to be a big deal to defer for a little bit, even if you're getting charged low interest. I wouldn't tell you to do that with something high interest like credit cards or something, but if things are tight, just know that these options, if you defer a couple months of payments, it's not going to affect your long-term plan. But yeah, thanks for having me, Peter. I'm really glad to be here today. It's looking like there's going to be a pretty nice day outside too, so I won't keep everybody for too long. But yeah, I think that as I've met with individuals and really just looked at the marketplace, our parents grew up in an environment where they were kind of in a higher interest rate structure than we as individuals with good credit are in today. Even individuals with not so good credit, interest rates are a lot lower now than they have been historically, which is a good and a bad thing, right? We don't get a lot of positive interest on safe assets like bonds and CDs and stuff like that, or really even our savings account. But really, stock market hasn't changed too much. We're still typically getting the same long-term interest rates. Over the past 10 years, especially since 2008, it's been a bull market. So it's a really good time to utilize the low interest environment that we're in.
Right.
So today, just for an example, I'm going to pick on student loans. I run into a lot of people who maybe their parents are telling them to pay off their debt before they invest. Sometimes I run into people who aren't even taking advantage of their employer match with their 401k, which is extremely important. For those of you that have heard of the concept of compounding interest and why Einstein referred to that as the eighth wonder in the world, this is going to be really insightful for you. But the individuals that haven't heard that, I'd expect it to be even more insightful. I'm just going to run through a scenario. Let's just pick on me. When I was 25 years old, before I was really even in the financial industry, I was talking with my advisor and talking about paying off student loans, and I'll just run you through the conversation that he and I had. So let's just say that I was 25. I was living pretty well below my means, and I was in the position to save $10,000 a year. Let's say that I had $50,000 in student loans at a 4% interest rate. And let's say that I was going to pay those off in 10 years if I pay minimum payments. So over the lifespan of that loan, at most, I would probably spend $10,000 of interest payments. And that's probably shooting way above what I would actually spend. These interest payments, I actually get to deduct off my taxes at the end of the year. So that's going to be actually less impactful than if you were just to pay off a personal loan. So, but let's just say that over a 10-year time frame, I pay those debts off on minimum payments, and I still have that $1,000 a month that I can put away into something like a 401k. Right. So if I look at the history of the stock market over a 40-year time frame, if I look at really any section in a well-diversified portfolio, if we're relatively risky, we can expect minimum a 7% growth rate over a 40-year time frame. So that would be almost worst case scenario. So let's say that I get a 7% interest rate over a 40-year time frame on average, saving between my ages of 25 and 65. So you know that's a 40-year time frame. Let's say that I save $10,000 a year. So pumping this into my financial calculator right now, and I'll kind of role play this with you, Peter. So knowing that I save $10,000 a year for 40 years, what is the basis or the amount of money that I put in? $400,000, right?
Right.
And if that's growing on average by 7% per year, what I refer to as compounding interest is, let's say that I put in $10,000 when I'm 25. That money is going to grow to $10,700 at 26, and it's going to grow to $11,500, and it's going to keep growing and growing and growing until 30 years down the line, it's grown to a pretty significant sum. And then 7% on that sum of money is going to be way more impactful than 7% on $10,000. But knowing that I saved a grand total of $400,000 over that time frame, growing at 7% per year, Peter, what would you guess that amount of money grew to?
Oh gosh, it's gotta be like in the millions.
Yeah, 2 million is what it grows to if it grows at 7%.
Yeah.
Right. So it grows to a pretty big sum of money. We get $1.6 million of growth.
Score.
Right. Yeah, it feels good.
Yeah, sure.
And let's say that that money grows by 8%. Then it grows to 2.6 million. It grows by 9%, grows to 3.4. But let's just stick with 7%. Let's just assume we get a pretty meager interest rate over the next 40 years. And let's say we talk to Travis in an alternate reality that made a different decision, and I pay off my student loans first. So knowing that I had $50,000, I could get rid of it in 5 years. Save myself maybe $5,000 in interest payments, which I get to deduct off tax anyway, so it's gonna feel more like maybe $3,000 that I've saved. And let's say that at that time, you know, I want to live in a nicer home. I have a family. I'm married. A lot of the times that excess money that we can save is going to go towards increase of lifestyle.
Right.
Is what I'm noticing. But let's just say that we can still save $1,000 a month, or easy math, $10,000 a year. But now I'm only saving that for 35 years because I still have my same long-term goal no matter what decision I make today. Let's say I save that for 35 years, step away at 65, probably still going to be in a really good financial position. But what do you think the ending balance would be if now I'm only saving $10,000 a year for 35 years, growing at 7%? Knowing that it was at 2 million, what would you guess the total would be now?
Probably about half of that.
About, it's 1.4.
Yeah.
So I'm 65, sitting on the beach, enjoying a Mai Tai. Do you think I'm going to care that much about the $5,000 of interest that I saved paying off my debt at 30?
Probably not.
Probably not. Do you think I'm going to care about an additional $600,000?
Hell yeah, you better.
Yeah. So, I mean, there's no perfect way of doing it. There's no right or wrong answer to whether we should pay off our debt first or invest in our future first. I mean, if we truly, truly, truly are being as mathematic as possible with low interest debt, we just want to pay minimum payments, even extend it. I extended my student loan payments over a span of 25 years,
Yeah.
which opened up $200 a month or like $300 a month to invest,
Right.
which is going to be way more impactful for me long term than if I were just to pay off my debt first. Now, one thing that is possible as well is if you do pay off your debt first, it is going to open a lot more money for you to save later. It's
Right.
just what I don't actually see that whole balance being saved typically. So if we're truly following a budget, following a plan, it's typically our clients are gonna be better off if we just have this interest rate arbitrage
Right.
we're playing the whole time. If we can borrow money and get a better interest rate on it long term, business owners do that all the time. It's you're going to over time build that snowball a lot faster.
Right. Right.
But when it comes down to it, if you're the type of person that you feel that you're going to save more money by paying off debt first because you hate debt, if that's your driving force and that's going to propel you to use more of your extra capital to pay off debt, probably going to make more sense to pay off debt and then save later. If you are super analytical, regardless of what decision you make, you're going to save the same amount of money. It's probably going to make sense to use this interest rate arbitrage in your favor.
Right. For sure.
So, and then, I mean, to think about it too, let's say that we are 65 and we have an additional 600,000 bucks. That money is still going to be invested, right? We're still in retirement going to have about 30 years, 35 years if we live to 100, who knows, with longevity. We're still going to use that money, right? We're still going to have that money invested. So that $600,000, by the time we're 90, could grow to 2 million, right? It could grow to 1.5, it could grow to 1 million, but it's still going to grow.
Right.
Right. Assuming the stock market continues to go up like it has historically. A lot of information, but Peter, as I was going through that, I guess what thoughts did you have?
Yeah, that's awesome. I know. So Parker dropped in here as far as managing our debt, investing. How do I tie all that into a budget? If I want to be doing both at the same time, $600,000, sign me up. For sure. So how do I manage it all in the sense of a budget that I'm also living off of?
Yeah, I mean, if we're at the position where we are truly only paying off debt and not saving anything, I would tell you to think through, like talk to your student loan administrator, your debt administrator, figure out if you could do, lengthen out the loan a little bit to open up a little bit more capital to invest. And I would do that. I would take that as serious as possible if we're not able to save at the expense of missing out on employer matches in our 401k. But we always need to make sure we're at least getting the employer match in our 401k.
Right.
But in terms of the budget, I'm very budget oriented. I'm the type of person where if I can take advantage of a low interest loan, whether that's the engagement ring I just bought, whether that's a car, I'm going to finance the whole thing. right? I piggyback loan my mortgage because I prefer to have the cash to grow. I finance everything so it fits in the budget. Then everything above and beyond it, I either save it or I spend it on the things that I want to spend it on.
Right. So
So in
talk a
terms
little bit
of,
about you finance, which congratulations on the engagement.
oh,
Very
thank you.
exciting. So even, talking about that, financing the ring, wedding coming up, all that, planning, talk about the finance aspect of putting even just debt on the books,
Mm-hmm.
at the same
Yeah.
time. And obviously there's an impact to credit score. There's an
Oh
impact,
yeah.
as well. So
Yep.
I guess agreeing to put this debt on the books, then longevity of paying it off, return on investment, all of that. Obviously, you get the return on the investment, you get a wife out of it.
Yeah. True. Yep. So in terms of credit score, there's a lot of things that impact a credit score. The biggest two are going to be your not missing any payments. And then the other one would be, let's say if you have a credit card open with like a $10,000 limit, you don't want to utilize more than really like 30% of the total limit. You don't want to max it out.
Right.
But if you have a really good credit and you have a lot of credit lines open, I think I could be wrong, but I heard to get a perfect credit score at 850, you have to have 10 lines of credit open.
Insane.
Which is weird.
Right.
But a lender, a credit score is essentially like a BMI when you go to the doctor for a bank.
Mm-hmm.
So it's a good way to give them an excuse to charge you a higher interest rate. I have a very good credit score. I was surprised when I did because of all the credit stuff I have open, but to a lender, a perfect credit is really anything over 760 or 780. If you do have a really low credit score, I probably wouldn't suggest financing a ton if you can just pay for it in cash.
Right.
Because if we have missed payments, we don't want to overextend ourselves. If things don't fit in the budget, then don't finance it.
Right. Right.
Or don't buy it.
Yeah.
Right.
So, and even talking about that, would love to dive into as far as like good credit versus bad credit. You do talk about financing your student loans are financed, the engagement ring, a mortgage, etc. What do you see as far as when you do open a line of credit that banks are mostly looking for? Is what is the drastic point as far as carrying student loan debt, other than obviously everyone wants the financial freedom? That's why we're here. We want to have that paid off, but longevity of it. What do you see as far as, average time span people carry their student loan debt, how it's impacting their overall financial wealth and freedom?
Yeah, with student loans, a good rule of thumb is if we are really strapped on the budget, we can't save any money. Like when we have medical professionals who have, upwards of $400,000 in student loans, typically we would rather see them structure that out like a mortgage, right? Because you get to deduct the interest off taxes. Long term, it's going to be more impactful for them, especially at that higher level. And then credit score wise, the more credit lines you have open that you aren't abusing, and the more that you are able to pay those off regularly, not missing a payment, no credit, no things that will impact your credit. I've never ran into anybody that has been paying their credit payments over and over and over again every single month. Student loans, say 10-year time frame is a really good time frame to pay off student loans. If we're paying those every single month, you have them on auto pay, you're going to have good credit. You will have good credit. If you miss payments, you will not. If you max out credit cards and you're not paying them off, you're not going to have good
Right.
credit. So longevity is just pay the minimums, just continue paying them, and you're not going to get any negative credit consequences. If you need to finance something, you can get a good interest rate. I mean, honestly, the long term, if you get a car loan on a 680 credit versus a 780 credit, sure, the interest rate might be a little bit higher, but it's not going to be that noticeable. It might be like $10 more a month.
Right.
As long as you continue to pay those minimums, you pay them, never miss a payment, your credit score will rise. When the credit score rises, you can start to refinance things and look into that. But yeah, credit score is extremely important, but it's not going to be important to get a perfect 850.
Right.
We just want to get over 750, 760 to be considered having perfect credit.
Yeah.
I hope that answers your question.
Yeah, for sure. And I guess to piggyback even on myself, for example, I mean, high credit score as well. As far as taking out loan, I mean, I think about home purchasing. I think about car payment, et cetera. So car payment is the only thing that I personally have.
Yeah.
I'm very fortunate that student loan debt is not an issue. And I really credit that to investments, honestly.
Yeah.
But I look at even kind of the next steps, investing into my future, as far as investing into a business, as far as investing into a home, et cetera, that's down the road. What do I even need to be looking at as far as, I mean, yes, I have a great credit score, but what other factors are going to influence that investment into my future?
Yeah. I think a lot of it will depend on, honestly, shopping around when it comes to when you're looking at loans.
Right.
I think I personally prefer to use a credit union when I'm placing loans, because the owners of the union are those that hold the accounts with the union. So that's helpful. It gets you better interest rates long term, and any profits are typically put into your account, which you can then use to just take out the profit in cash, or you can pay it towards debt. Say if you get loans with a something like Wells Fargo, which is not good or bad, but it's a stockholder company, to where the profits are given back to the stockholders, and you typically might not get as good of interest rates at a bank than you would a credit union.
Right.
But you can only figure that out by shopping around, right? So that's like no recommendation to say use a credit union over a bank. Just make sure to try a lot of different avenues. And then when it comes down to things like mortgages, when we're thinking of the paying off the debt versus investing, when you're setting up a mortgage, that'll come in handy big time, because if we're thinking about something that's $250,000, that's a pretty significant debt. Right. And if we're thinking of it rather than, a 15-year payoff rather than a 30-year payoff, 15-year payoff, although over the lifespan of the loan, you're going to pay way less interest, you're going to have a lot less time for that money that you're investing to compound.
For sure.
So what I would recommend is during those times, just to probably consult both the person who's doing the loan, consult a professional to help you think through those big ticket decisions.
Right.
So you can then make the decision which is most confident and comfortable for you.
Yeah, for sure.
Yep, there's no right or wrong answer. It's just whatever you feel is best for you. But as long as you're intentional about it and you're saving money and investing money, it's more of an issue of and rather than the or. It's doing this and this rather than doing this or this.
Yeah, 100% agree on that.
Hmm.
So, and lots of likes on that coming through on the Facebook live as well. So, I guess final tip as far as student loan debt right now, debt management, investing in our future. Um, what are you seeing as the biggest opportunity that young professionals, millennials,
Hmm.
really anyone can be doing right now?
Yeah. The two things that I would say make sure to do is at least pay the minimums for sure, and at least get your employer match with your 401k.
Yeah, for sure.
Those are the two things that you have to do. With any excess money, whether you're paying it off towards debt or whether you're investing it, both of which are going to be really impactful for you long term.
Yeah,
It's just I would just use this more as just another thing to keep in the back of your mind.
right.
Me personally, I choose to invest all the extra money I have. For others, they might choose to pay off debt with it.